Hello traders, welcome back to LiL Forex Academy, where we learn, trade and earn. In the previous video, we talked about forex market makers, but today we are going to discuss something even more important: liquidity. If you truly understand liquidity, the market will start making much more sense to you. You will begin to understand why price suddenly spikes, why stop losses get triggered, why breakouts sometimes fail, and why the market moves aggressively after taking liquidity. So let's break it down in a simple way. First, what is liquidity? In simple terms, liquidity is the availability of buyers and sellers in the market. For a trade to happen, there must be two sides, a buyer and a seller. When there are many buyers and sellers at a particular level, we say that area has high liquidity. Liquidity is what allows the market to function smoothly. Without liquidity, it will be very difficult to execute trades. Large institutions, banks, and hedge funds rely heavily on liquidity because they trade very large positions. They cannot simply buy or sell huge amounts without finding enough order on the opposite side. Now let's talk about where liquidity exists. Liquidity usually exists in places where retail traders place their orders. Common liquidity zones include above the previous high, below previous lows, above resistance levels, below support levels, around trend line breaks, around breakout entries. Why? Because many traders place stop losses in these areas. For example, if many traders buy at support, they usually place their stop loss below the support level. That means below that level, there are many stop loss orders. These stop losses create liquidity pools. In trading, liquidity is often divided into two main types. Buy side liquidity is found above highs. This includes stop losses from traders who sold the market, breakout traders placing buy above the resistance. When price moves above a high and trigger these orders, it is collecting buy side liquidity. Sell side liquidity. Sell side liquidity is found below lows. This includes stop losses from traders who bought the market, sell order placed below support. When price drops below a low, it is collecting sell side liquidity. Liquidity is extremely important because large institutions need it to enter and exit their positions. If a bank wants to buy hundreds of millions of dollars worth of a currency pair, they need sellers to fill those orders. This is why prices often move toward area where liquidity exists. The market tends to move from one liquidity pool to another. This concept is one of the foundations of smart money trading. Many retail traders focus only on support and resistance. They ignore what is happening around these levels. Sometimes price breaks a level briefly, trigger stops, and then reverse. This is often called a liquidity sweep. After liquidity is collected, the market often moves strongly in the opposite direction. This is why many traders experience the frustrating situation where their stop loss gets hit and then the market moves exactly where they have predicted. Smart traders think differently. Instead of chasing breakouts, they ask, where is the liquidity? They look for equal highs, equal lows, stop loss clusters, liquidity pool above and below the market. Then they wait for the market to grab liquidity first before entering a trade. This approach allows them to trade with institutional movement instead of against it. Understanding liquidity can completely change how you see the market. Instead of reacting to price, you begin to understand why price moves. If you found this video helpful, make sure you subscribe to LiL Forex Academy, and in the next video, we will take this concept even further and explain how smart money manipulates liquidity in the forex market. Trust me, you don't want to miss that one. Until then, learn, trade, and earn. Cheers.